This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. And so today I am really happy to have my first Skype guest, Mike Dever. Mike has been trading for a while. He has a little bit of experience, and I'm not going to attempt to go over all the details of his background. I'm going to let him tell a few things, but let's just say that Mike has seen systematic trading for at least a couple decades. And it's interesting in my world where I've talked to so many systematic guys, so many trend trading guys in the CTA world, the commodity trading world. I've not had a chance to spend time with Mike yet, or really sit down with him. Even though years and years and years ago, I was sitting at several panels that he would moderate when I was trying to acquire information and learn how things were done. So, anyways, I do want to introduce Mike. And Mike, I was wondering if you could give the audience a little bit of a background on how you got started, and maybe even start with, take it back to your first trade.
So my first trade was actually in gold call options, which pretty quickly, within a couple weeks, I started learning about futures, moved into a futures position. And for the next few years, I traded a variety of futures, agricultural, precious metals, financial futures, and turned that into a business in 1982. That was when I set up my first fund.
So, 1982, we're talking for people to be thinking about systematic funds and trend trading, and I mean we're talking at a point in time where you must have felt like to some degree you were out in the wilderness. I mean there wasn't a tremendous amount of feedback. It was a small, I don't say this in a negative way, but it was a ragtag group of guys to some degree, wasn't it?
Oh, absolutely. Yeah, I mean it was a lot of gunslingers at the time as well. I started out doing research on a mainframe computer at the local university. That's how I started backtesting some of my original trading ideas. But at the time, I mean, the chart reading was what people did. People didn't use computers. There were only a handful of people that actually had computers in their trading operations. I called around. I talked to a number of the guys that the Bill Dunns and the Campbells of the world, and found out what they were doing, and really kind of got into the business a little bit that way, talking to them. One of my early guys I met in the business was just also starting out, John Henry. We met at one of the early conferences in the early 80s. But at the time, it was very primitive. The strategies were primitive. Everybody's trading approach was mostly seat of the pants.
Well, when you say seat of the pants, though, they did have systems. I mean, I remember when I first met Bill Dunn, I believe it might have even been, was it Fortran? I mean, they did have some early coding and putting things together and tracking things in a fairly systematic way. So I just wonder if you maybe might clarify even on that to some degree.
Well, I think what's interesting is the guys you mentioned are around today, and that's why we talk about them. At the time, though, the majority of the traders were literally seat-of-the-pants traders. They'd be sitting in their chair, they'd be watching the market move, and they'd make a trade. The reason we're not talking about them today is because the systematic guys trounced them. They didn't have the consistency or the predictable, capability of having their strategies work decade after decade. They flamed out.
Yeah, it's... because I've gone back and I've looked at a lot of the traders over the years, and there are a lot of names from back in the day that are not around today. But I think one of the things that's really near and dear to your heart right now, because I believe it's your first big investment style book, would be this delightfully, and I give you all the props for going with it. I know there's an alternate title, but you went with the ballsy Jackass Investing, Don't Do It, Profit From It. Now, I think I'll let you go ahead and address that, because a lot of people sometimes say, well, that's really in your face, but that's how we all talk behind the scenes a little bit. We're not all cursing all the time, but there's a reason for that. So why did you choose such a grab you by the title?
Yeah, exactly. The original title of the book, I first came up with the concept for the book, which exposes 20 common investment myths. It says why they're myths, not facts, and then goes through and tells the readers how to exploit those myths for profit. Actually, in the very end, turns it into a model portfolio they can create. It started out with exposing the myths as the title. And I had some friends that told me it wasn't catchy enough, and so I started thinking about other titles. But for a decade, that was my title. That's what I wanted it to be. As I got near completing the book last year, it was shortly after the Jackass movies came out. And I realized, okay, these are a bunch of guys, essentially, they're a bunch of jackasses. And all they're doing is taking unnecessary risks just to get into a movie and make people laugh. And I thought about what I was writing about, and it was that how conventional investment wisdom was teaching people to take unnecessary risks. And it just clicked in place right then. I said, you know what, jackass investing, that's my definition of people taking unnecessary risks with their money.
Well, I'm not going to, what I think I'm going to do is I'm not going to go through, you've got 20 great myths here, and people are going to need to go ahead and at least take a look at the book. And it is a book that I highly recommend, just for the pure insights and the research that went into it. It's something that you should take a look at to see behind the scenes, as somebody who's been in this business for over 2 decades, how they look at the world and what they've learned. But I'm going to jump right in and let you go ahead and elaborate on myth 1, because this is probably, and there's a reason why it's number 1, probably the single biggest thing that you see in the average investors. And what I mean by average investor, that could be a doctor or an attorney who has a significant income, but they have, perhaps they've not put the time in to think about what a return driver might be, and that's your term, I'm going to let you explain too. But what a return driver might be, and where the sources of these returns come from, and the best way to go about them. And your myth number 1 is stocks provide an intrinsic return. Now, that's something that everyone has told me, or I've heard in the news, upside and downside forever. You just buy and hold, you get intrinsic return, it's just going to keep coming back to you, and just hang in there. And
that's right. I don't
think you look at it that way.
Yeah, exactly. The reason that's first myth in the book is, first, it's one of the most prevalent myths out there. And second, it gave me the opportunity of introducing the concept of return drivers. Stocks provide an intrinsic return. It's quoted, it's stated as if there's some sort of just magic and it just happens. And the reality is you can trace everything back, every market move and every potential investment, to what drives it, which I call return drivers. And in the case of stocks, if you break it down, there's 2 primary return drivers that move stock prices. One is the earnings growth of the individual companies that have the stock is on, and the second is the multiple people are willing to pay for that earning. And what's really interesting is that in periods of under 20 years, the stock prices are dominated by the PE ratio. The enthusiasm for people either to own or to disown stocks. It's not the earnings of the companies. You can go 20 years, companies can grow and grow and grow, and the stock price can go down because people lose enthusiasm for it. Now, what's important about that, it isn't so much the answer to it, it's just that we're able to identify what the drivers are. And so now once you know the drivers of that, you can determine strategies to trade those markets to make money and to profit. And without that knowledge, you're investing blindly on the fact that, well, because it went up in the past, it's going to go up again in the future.
Maybe I should let you elaborate, because I thought it's a great phrase, and when I read it, I immediately wanted to steal it and start using it myself. So I guess I'm stuck now, because if I start using return driver everywhere, people are going to be like, oh, I know where you got that from. But why don't you go ahead and explain from your perspective to the layman and the experienced investor trader out there, when you use the phrase return driver, what do you mean and why do you mean it?
Okay, so it's that smallest basic piece of data, of information, of concept that dominates the market movement of a commodity, a stock, whatever it might be. In the case here, we identified that there's these 2 common return drivers. Once we've understood that, earnings growth is one, people's enthusiasm for owning stock is another. You can develop strategies, and that's the next level, to capitalize on those return drivers, to exploit them. I give different examples of return drivers through the book, and in our actual trading, everything comes down to a return driver. One example I give in the book is talking about a cost of production model for trading in commodities. And the concept there is that if a market is trading at or near its marginal cost of production, it's going to receive pressure to hold the price up. And it may be in a downtrend, it may want to go lower, but the reality is at some point that cost of production information is going to support that price. The people aren't going to continue to sell it, producers aren't going to sell it below the cost of production, and more people are going to buy it if it's trading at such a low price. So that serves as a floor support level. That's a return driver for a strategy we developed to trade counter trend in the markets based on a marginal cost of production model. So it's always understanding what that basic return driver is you're trying to capture, developing a trading strategy around it, and then you can systematically exploit that return driver through that trading strategy over time.
Yeah, I'm glad you used that phrase at the very end, systematic, because obviously I've become known for writing about trend trading, which is a technically oriented strategy, and there's not a big use of fundamentals. But I think the real issue, or one of the real issues that you're addressing, is the systematic part, which is you're saying if I can look at those return drivers. And so when you're talking about fundamentals, you're not talking about sitting at your desk, as you say, by the seat of your pants. You're talking about using fundamental information in a systematic way to make your trading decisions for some aspects of your overall trading.
That's correct. Absolutely. Everything we do is systematic, and it goes back to the original discussion we had when you talked about, I talked about seat of the pants traders in the early 1980s. And that was the predominant method for trading at the time, if you talk to traders, but they're not around today. The guys that are around today and that still have track records that go back 30 years are the systematic traders.
I hate to use this word. I've not really used it much over the years, but I guess if there was ever a secret sauce, this idea that then one of the old phrases, if you can, count, count and keep track, measure. And I guess the systematic way of thinking is you've obviously learned that for many decades now.
Well, I think one of the things it does, and maybe sometimes without people knowing it, is it forces them to identify trading strategies that withstand the test of time, where if they're not using something that's systematic, they may be looking at something that anecdotally, a concept, a type of trade that worked well over the last few months, and they fooled themselves into thinking that's got more permanence to it, when in reality it's very transient. And they continue to employ that, they start losing money. They don't even know why they're losing money. They don't understand the return drivers or the back testing concept of that strategy.
So I've got another myth here that I'm looking at that I've spent some time writing about why this is not true, but you're very blunt about it. Myth number 3: you can't time the market.
Yeah, absolutely. This is supported. The fact that you can't time the market is supported by virtually all the research out there. Dollar bar studies are what I include in the book that show that over the last 20 years, investors in mutual funds underperform those mutual funds by 5% per year. So if they just bought a mutual fund at the beginning of the 20-year period, held it to the end, they would have done 5% better than they actually did, because they rush in when the fund's doing great, and they get in at the top, and they sell out of those funds at the bottom. So the evidence is out there saying, well, see, people can't time the market. Well, the very fact that those people can't time the market, that they're responding emotionally and losing money, is the reason why you can time the market. You just have to identify when they're doing what they're doing and do the opposite. And I actually start the chapter off with a little anecdote, the story of the Seinfeld episode, The Opposite. And it's one of my actually favorite parts in the book, and it's when George Costanza's sitting in the coffee shop, and he sits there saying, every decision I've ever made in my entire life has been wrong. My life is the opposite of everything I want it to be. Every instinct I have in every aspect of life, be it something to wear, something to eat, it's all been wrong. And I think so many investors, people, I don't necessarily call them investors, but people that are playing with their money feel that, and they can relate to that. And so in this chapter, we agree that the majority of people can't time the market, but that's the very reason you can time it.
So, Yeah, I think most people are going to be listening here. I don't know how much explanation we need to give there. I mean, it's like you kind of just need to stop for a second and say, well, if I guess I've got another way of looking at it too, is if this timing stuff doesn't work, then how are all these people in the industry, including yourself, how you put together these track records? I mean, it just forces people to say, well, hold on, we see all the studies, but then why do the Bill Dunns, the John Henrys, the David Hardings, the Salem Abrahams, why do they exist then? Explain that to me.
Right. Well, there's a couple things, and I'll jump on that. I do want to point out that in the action section for the book, which is on the jackassinvesting.com website, the action section for Myth 3, I do give a specific example of a trading strategy that uses, it essentially exploits people's behavior when they're moving in and out of mutual funds to allow you to time the market. So, it's something people can go and take a look at and start to understand it better. But the one myth in here that really relates to what you're talking about and trend following in general is myth number 7. It's bad to chase performance. And that's capturing the return driver, and a lot of people argue over what reasons there might be for that. I just read something in Fortune, Cliff S. Ness put in there, but talking about essentially these trends get perpetuated. People, in my mind, will continue to do and be reinforced in their behavior, even if it's wrong, if it turns out to be rewarding to them. So even if they were wrong on the wrong side of a market necessarily in the beginning and it started going their direction, they start getting reinforced that they made the right decision. And other people see that and they jump in as well, and you perpetuate these trends. And it's really just a matter of that's more psychological exploitation in a way that the trend followers would be able to capitalize on. So you can time the market. In that case, you're not timing it by buying low or selling high. You're buying it by chasing that performance.
I've got a couple more of these that I have to get you to elaborate on. Myth number 9, risk can be measured statistically. And I guess what comes to mind there for me is when I think about trading, it seems like one of the main things, and some might argue the only thing that we can really control, is how much we can afford to lose, or how much we can lose of our limited capital. Why don't you talk about the idea that risk can be measured statistically? I mean, I think a lot of people, when they hear the word risk, they don't even attach a number to it.
Mm-hmm. Well, a lot of people try to. Certainly institutional investors, Sharpe ratios, and you hear about volatility all the time. And what I mean by this, and I go through examples in the chapter, are that you can look at volatility, and without understanding the underlying return drivers that created that return stream that you're looking at, you have no idea how risky that is. So you could have strategies, options writing, very simple, straight up example, that might work years on end, where people are collecting a premium, low volatility, nice returns that are totally misleading. That volatility is totally misleading the underlying risk that's inherent in that strategy. So until you understand what the return drivers are, you have no idea what the risk is. And the measures that you're looking at give you no indication of what the underlying risk is.
How did you, I know we talked a little bit about you early on, but just to comment that idea, like, where did that start in your life? I mean, how early did that insight happen?
Pretty early. I toyed around, I guess, I say pretty early, but, relative speaking, it probably took me about 10 years of trading and doing a lot of seat of the pants, discretionary trading on my own, in addition to building systems, before I started realizing a lot of the things that I wrote in this book. And I'd say most of it was solidified in the second decade, which for me, through the 1990s, where I developed systematic models, we traded those, they did great. And that was the sort of the reinforcement of what I had learned through the 1980s. And in some cases learned incorrectly, because a lot of the stuff I read early on was just flat out wrong. So it took a little while, but once I got kind of settled into that way of thinking, it's stuck with me 20 years, and I continue to see it supported in the marketplace.
I have two more you have to let me go with, and then I won't keep you on the phone all day. I seriously, I would keep you on the phone for a couple hours here. Futures trading is risky. I mean, we've got MF Global in the news. and just the whole idea that there's a bunch of cowboy Chicago guys doing things, and it's just too risky. Futures steer clear.
Well, obviously the MF Global and the news had nothing to do with Chicago cowboy guys. I think they were the guys that tried to hold things in line. It was the Wall Street Masters, and the other title of this book, Exploiting the Myths, is subtitle on that is Profiting from Wall Street's Misguided Beliefs. So a lot of those guys think they know what they're doing. They have no clue. It doesn't matter that they're big guys and they're big institutions. They're still individuals that have no clue. They just have more zeros, that they're playing with. What I go through in this chapter, Futures Trading is Risky, is the myth, is just the general perception of people. They hear it over and over, how you lose money trading futures, and most people lose money in the trading futures. Well, it really gets down to just a couple things. If people take too big a bet, they over leverage their positions, they're going to lose money. And I don't care whether you're doing that in futures or they're doing that in sovereign debt or they're doing that in stocks. They only need a few mistakes and they lose a lot of money.
Real estate would be another great example too.
Absolutely. Highly leveraged. They're sitting there saying, well, we'll never have a 20% drop, so I'll never lose my money. Next thing you know, the market's down 40% and they're wiped out. And so leverage is the risk. It's not the futures that make it be the risk. So what I do is I kind of go through then and show some examples, and I use the Barclay indexes for managed futures to really point out how much less risky futures trading is if it's properly managed than what people consider to be the buy and hold safe thing, stock investing. And it's the numbers are there. It's very clear when you see it. But it has to be properly managed. And the problem with futures is it's easy for people to get leverage in futures, and people being people, the majority of them, without a systematic plan, are going to abuse that and lose money.
Well, sure, you see all that leverage, and you're like, well, I need one big hit, and you start to imagine what, some 10, 20 to 1 boom, and all of a sudden you're rich overnight.
Absolutely. Everybody extrapolates out their first big win, and, pretty much they're going to own the world.
Let me end with one last one, and then we'll kind of wrap up. But you've kind of gone into this a little bit, but myth number 14. Government regulations protect investors. Now, I'm assuming that the nice people in Washington, D.C. wake up every day and all they're concerned with and all the legislation they pass is concerned with only protecting me and my money. That's not true? Come on, tell me. Don't tell me that.
Yeah, the problem you have with government regulations is most of them don't understand the markets they're regulating to start with. So you end up with a mismatch of laws that are counterproductive to what they're really trying to achieve. When I got into the business in the early 1980s, it was virtually impossible for a commodity pool to be offered in Texas because the Texas regulators, the Security Commission, being the big brother and watching out for their people as they did, they deemed those to be too risky. So people weren't allowed to invest in those. You didn't even have the opportunity to look at investing in those. That's an example of government going overboard to try to protect the people based on inaccurate information. And you see that over and over. So now you've got a couple of different regimes. For example, you got the SEC side for securities, you got the CFTC for the futures side of things, and they've got a mismatch of rules. For example, a mutual fund cannot show past performance. It's illegal. It's not allowed to show past performance of the management company's other funds. If it's your futures trader, you have to show the past performance of that management company's other funds. Where's the logic in that? They can't both be right. And so what you see is just a lot of regulations that were set up because somebody at the time was responding to some specific event, put it in place, and it's actually caused people to have less choice, less ability to diversify their portfolios, less easily understood information to be able to make and evaluate properly investment decisions.
It's funny you mentioned that big state down in the South. Well, I love Texas, been there a bunch, but I've sparred on multiple occasions with an individual who has been at certain points in time, and we won't name names, has managed large pieces of public pension money in the big state of Texas. And we've sparred over these very conversations where he says the very things that you're talking about, like, well, they're too volatile, they're too risky, futures, and all these myths you're talking about, they come right out of the mouth of the very individual who's literally in charge of managing billions of dollars worth of people's investments.
That's right. Just because they have more money to manage doesn't mean they're more intelligent or knowledgeable. I sent them down Chapter 12, Futures Trading is Risky. Take him 15 minutes to read it, and hopefully it'll open his eyes.
Yeah. Listen, Mike, why don't we wrap up, and I'm going to let you've got a couple different websites, maybe let you tell people where they can, your book's easily found on Amazon, Jackass Investing, and, Mike Dever, boom, boom, it comes right up, easy to buy. But is there the best place they can find more information on you and maybe how to reach you even, possibly?
Sure. Okay. Yeah. The website for the book is jackassinvesting.com. So we have more information there. I've got a blog I post to on occasion in that, and we also have the action section, which is, in addition to the 280 pages of the book, another 80 pages and more research with specific actions people can take to create a diversified portfolio. And then my management company, Brandywine.com. So just www.brandywine.com. And they can learn a little bit more about me and our trading philosophy, and what we do as a firm.
Mike, I appreciate it. And, hopefully we can kind of keep an ongoing conversation moving forward here, because I think even if you've got a quick idea and you want to talk for 15 or 20 minutes and we can get it out, I know people love to learn from people that have been there, done that, seen it, and we've only just touched on some of the experiences we could probably go to, and your foundational thinking and how you grew up and how you approached all these things. We'll save that for another conversation, because I would love to learn, frankly, even more myself.
Well, that'd be great, Mike. I appreciate it. Thank you.
So, Mike, I appreciate it today, and we will talk again soon.
Thank you much.
Take care.
Bye.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.